The book Warren Buffett said it is, by far, the best book on investing ever written. The Summary of The Intelligent Investor by Benjamin Graham. Chapter 1. Mr. Market. Imagine your stock market is a person. Let's call him Mr. Market. And here's how he behaves. Every day he's offering to buy or sell you shares of your company. And every day the offer is different. Sometimes he's feeling great. He's euphoric. He'll say, "I'll give you $120 per share." But then other days he's super sad. He's fearful, and he'll say, "I'll give you $80 per share." What a weird guy, right? But that's the stock market. It changes every day. Now the wise investor knows this. They know Mr. Market is moody, so some days when he's overly happy, they ignore him. They won't sell him anything. But then other times when he's super sad and selling you the same stock for way less than yesterday, the smart investor will buy from him. The whole point is, if you want to make money in the stock market, you need to think long term. Don't get caught up in Mr. Market's emotions. Chapter 2. The Speculator versus the Investor. There are two types of people in the stock market. First, there's the speculator who bets on short-term price action. They try to guess where the stock might go tomorrow, next week, or next month. Then there's the investor who buys assets that have an intrinsic value. They look at the long term, and they're not scared of holding something for 5 or 10 years. But here's the thing. Most people want to be investors, but unknowingly, they actually behave like speculators. They see a stock go down and freak out, thinking they got scammed, only to find out 6 months later it was a brilliant investment. That's why Benjamin Graham says that most people confuse speculation with investing. If you want to avoid this before you buy any stock, ask yourself, will I be happy holding this for 10 years? If the answer is no, then you're probably trying to speculate and not invest. Chapter 3. Margin of Safety. Buying a stock is like buying a used car. You don't want to pay the exact amount the car is worth because you never know. Maybe there's something wrong with the engine, or maybe you'll find out later that there's been an accident. The same goes for stocks. They might seem cheap today, but you never know if the business will fail next year, or if there's something wrong with their accounts. That's why Benjamin Graham says you should always buy with a cushion, meaning the market price of the stock should always be well below its intrinsic value. If you do this, you're protecting yourself from errors in judgment as well as unexpected downturns. For example, let's say you bought Apple stock last year at $170 per share. Now the stock is trading at $150 per share. Would you feel comfortable selling now? Probably not. Even though the stock has technically lost 11%, your cushion should protect you from such losses. Chapter 4. Defensive versus enterprising investor. There are two types of investors, defensive and enterprising. A defensive investor wants safety and simplicity. They're usually older and don't want to spend time researching stocks. For them, it's all about lowering risk. These investors tend to focus on index funds, bonds, or blue-chip stocks. Then on the other hand, there's the enterprising investor. They're younger and willing to do more work, spend more time finding undervalued stocks, and therefore accept more risk. In return, they hope to earn a higher reward. Benjamin Graham says most people start off as defensive investors, but then slowly turn into enterprising ones without even realizing it. Chapter 5. Intrinsic value. Imagine you run a lemonade stand, and every year you make $10 profit. Now someone comes along and offers to buy your lemonade stand for $50. Sounds like a great deal, right? Well, not so fast. The $50 is just the market price. But what about the actual value of the lemonade stand? Maybe it costs $60 to build, or maybe it's worth $100. That's the intrinsic value. And this concept is the same for stocks. Just because a stock is trading at $100 doesn't mean it's actually worth that much. You need to dig deeper into the business, analyze their earnings, assets, and dividends, and figure out what the stock is actually worth. Once you've done this, you'll have the intrinsic value. If the market price is below the intrinsic value, it's undervalued, and if the market price is above the intrinsic value, it's overvalued. Chapter 6. Common Stocks as an Investment. In this chapter, Benjamin Graham explains the difference between a liquid and an illiquid investment. Liquid investments are very easy to turn into cash, things like bonds or savings accounts. On the other hand, illiquid investments are harder to convert into cash, such as real estate or fine art. And here's the thing. As a general rule, illiquid investments tend to be worth more. Why? Because you can't just quickly sell them. You need to hold them for the long run. Common stocks fall somewhere in the middle. They're more liquid than real estate, but less liquid than bonds. Because of this, common stocks can offer higher returns than bonds, while still being less volatile than real estate. Chapter 7. Some Basic Rules for Stock and Fund Investment. Benjamin Graham gives us 3 golden rules for investing in stocks. Number 1. Don't buy any stock unless it's selling for less than its intrinsic value. Number 2. Never buy a stock that isn't good enough for you to hold for an indefinite period. And number 3. Only invest as much money as you're willing to lose. If you follow these rules, it means you're not chasing short-term profits. You're investing in great companies at a fair price, and you're not risking money that you need in the future. Chapter 8. How to Evaluate a Stock. This is the heart of the book. Benjamin Graham takes you through multiple ways to value a stock, including looking at past performance, industry outlook, competition, dividends, and economic factors. It's pretty complicated, but here's the gist. You want to invest in companies that are leaders within their industry. They should have a strong competitive advantage and a history of growing their earnings. Chapter 9. Convertible Securities. In this chapter, Benjamin Graham talks about investing in bonds, which he calls the most conservative of all investments. Bonds are loans to governments or big companies, and in return, they pay you interest. Now, generally speaking, the longer you lend your money, the higher the interest rate. For example, if I lend you $10 for 1 month, you might pay me back $12. But if I lend you that same $10 for 5 years, you might pay me back $125. The math works out to be the same. But really it's all about how much you trust the borrower. That's why government bonds are the safest. Everyone trusts the government to pay them back. That's why government bonds usually have the lowest interest rates. Chapter 10. The Psychology of the Stock Market. We often think the stock market is this rational place where price equals value. But that's not true. The truth is that the market is driven by psychology. Investors are emotional beings, and sometimes their emotions cause the stock price to go way up or way down. Take GameStop, for example. In January 2021, the stock went to the moon because retail investors banded together and decided to squeeze Wall Street. This is a prime example of how the stock market isn't always rational. Sometimes investors let their emotions get the better of them and make irrational decisions. Chapter 11. Stock Market Cycles. The stock market goes through multiple cycles. Over time, there's the long-term trend upwards. Then there's also the shorter-term peaks and troughs. Usually when the market is crashing, that's when people panic and they freak out. But if you zoom out, you'll see that this dip is just one of many in the long-term trend. Benjamin Graham says that the stock market is a device for transferring money from the impatient to the patient. Chapter 12. A Stockholder's Duties. Being a shareholder means you own a tiny piece of a company. That's why it's important to attend shareholder meetings, vote on important matters, and stay up to date with what's going on with the company. By doing this, you'll be able to assess whether management is doing a good job or if they're making mistakes. Chapter 13. Stock and Bond Valuation. In this chapter, Benjamin Graham takes you through multiple examples of how to value both stocks and bonds. For stocks, it's all about understanding the business. Then for bonds, it's about working out the cash flows and the yield. The math is quite complex, but the idea is to understand the basics. It's not about memorizing formulas. Chapter 14. Is the stock market a good buy? Benjamin Graham runs through 4 questions that you should ask yourself before investing. Number 1, are the current prices reasonable? No. 2, is the market discounting important facts? 3, is there likely to be a change in the future dividends of your stocks? And number 4, is the investor himself changing? If you're honest with your answers, then you can figure out if the stock market is a good buy right now. Chapter 15. Generalizations about value stocks and growth stocks. There are 2 types of stocks: value and growth. Value stocks are those that are trading below their intrinsic value. These stocks usually pay good dividends and have a history of stable earnings. On the other hand, growth stocks are those that are expected to grow faster than the overall market. Usually these stocks don't pay dividends since they reinvest all of their earnings back into the business. Chapter 16. My Own Verdict. In this final chapter, Benjamin Graham gives us his verdict on the stock market. He says, in the short run, the market is largely unpredictable, and even the best-known laws of economics and statistics do not help us to forecast its behavior. But this lack of predictability does not keep the market from having a trend which, when recognized, may prove highly profitable to the patient investor. So what is the secret to success in the stock market? According to Benjamin Graham, it's all about being patient and only buying when the market is giving you a good deal. That's it. Now remember, I am not a professional investor, and everything I share is just my own personal opinion on the book. With that being said, please do me a favor and comment below if you enjoyed this type of video. And if you haven't already, make sure you subscribe.